Hi, my name is Grant Reeves. I'm the co-founder and managing director for Stoic Equity Partners, a commercial real estate investment firm in Daphne, Alabama. We are currently raising equity for a new fund, SEP Industrial Holdings 1, which buys multi-tenant flex industrial value-add properties throughout the Southeast. Thank you to Starlight Capital for having me today, and thank you for your time. So this is a 506c offering, so it is available to accredited investors only. Feel free to read the rest of this disclosure later if you would like. We are raising $25 million in equity. We're going to bring in about $50 million worth of debt guaranteed by the sponsors for a total portfolio size of about 75 to 100 million. It is a 5-year closed-ended fund. We are primarily investing in secondary cities in the Southeast. So these are populations between 500 and 1.5 million in buildings that are built in the 80s and 90s. This is the value add play. So we're looking for properties that need renovation, managerial issues that we can correct, as well as be able to push rents to be able to drive value both on cash flow as well as capital appreciation. Flex industrial is a commercial real estate product type that is made up of multiple office and warehouse suites. This is a property that we own in Little Rock, Arkansas. It is 48,000 square feet total, made up of 16 3,000 square foot units. Flex industrial suites can have varying degrees of office to warehouse. Some will even have 60% office, while others will be 10% office. And as you can see on this building here, you'll have dock highs or roll-ups along the back, and then storefront kind of office entrance on the front. Typical leases are going to be 3 to 5 years. It's a range of tenants. So you'll have anywhere from home service companies, so like HVAC, plumbing, that kind of thing, to e-commerce companies, logistics firms, and even life science space. We mainly invest in this property for 4 reasons. Number one is very high demand, very low supply asset class. There's been such a little amount of this product built over the past 2 to 3 decades that the supply and demand metrics are just completely out of whack, which we can capitalize on. Number two is we're buying well below replacement cost. On average, we're buying assets at about $93 a square foot. Replacement is about $130 to $140 a foot. It's a very nice place to be for us because we're in a situation where no one can build on top of us because the numbers, frankly, don't work to build new flex industrial product in the majority of the markets we play in. Number three, the vacancy risk is mitigated by having multiple tenants. We'll have up to 30, 40 tenants in a complex. So if 2 or 3 of them leave, this is not a big deal and does not hit the bottom line as if you were a single tenant building, for instance. Number four, this is where business gets done. We are protected from the work from home trend based on the fact that if you need to have a large part of your workspace be warehouse, you can't go work over Zoom. You have to have a space to be able to do your job efficiently and run your business. The target markets, we primarily invest in more linear markets. So these are overall MSAs that maybe aren't your super high growth. So we're not investing in the Nashville's, Austins. We're investing in the Memphis, Tennessee's, Birmingham, Alabamas, which are large enough MSAs that have high growth markets or submarkets within the overall MSAs, but are not absolutely blowing up. The reason we do that is we're able to achieve a lot better cash on cash returns to be able to distribute to investors throughout the whole periods. This is throughout the Southeast, so everyone from Texas up to the Carolinas and kind of everywhere in between. Again, we're raising $25 million. We'll bring in $50 million worth of debt for approximately $75 million total worth of capital to place. And we are projecting returns in the 7 to 8% cash on cash returns average. Now, this is a value add fund. So first couple of years will be lower cash on cash, maybe 4 or 5%. Later years will be higher, like maybe 9 to 10%, which will average back into that 7 to 8% return piece. We also will have about a 15% plus IRR as our target. And when we put properties together, some will be heavier cash on cash returns, some will be heavier IRRs, but we'll mold them together to be able to put the portfolio together to be able to achieve those returns overall. The fund structure offers $50,000 shares as well as $1 million shares. We offer an 8 pref for $50,000 shares, a 12 pref for $1 million shares, and then we co-invest 5% along with the fund on all of our acquisitions. We do charge a 2% acquisition fee going into properties, 50 basis point and an asset management fee, and a 1% disposition fee. We currently have 3 properties under contract that we will be buying in the fund. This is the first one, is a 128,000 square foot complex in Louisville, Kentucky. It's a great value add property. We're assuming CMBS debt on it, and I'm very excited about that property. The second is a 158,000 square foot portfolio throughout the Jackson, Mississippi MSA. Currently, these buildings are occupied by a lot of credit tenants. We have FedEx in there, Tyson Foods, and a lot of big name tenants, but just a great opportunity to be able to go in there, push the rents, and see some great cash on cash throughout the whole period. We then have a property under contract in McDonough, Georgia. This is 90,000 square feet. It is currently being bought for approximately $64 a square foot, which gives us huge upside and be able to achieve a great IRR overall. Here's my contact information, as well as a couple of QR codes to get in touch with us. We'd love to tell you more about our fund, a little bit more about Flex Industrial, as well as this overall opportunity. Thank you for Starlight for having me, and have a great day.